this session. And now, royalty is payable by a user to the owner of the property or something on which an owner has special rights. Now, the royalty agreements are always prepared between the owner and the user of maybe a property or the user of maybe a right. Now, if the payment is made to purchase the right or property, then that will be treated as capital expenditure instead of a royalty. So when you purchase a property, now it becomes yours. Now you are no longer leasing that said property. So in such a case, we will not have a royalty because you are the ultimate owner. Now, if we look at some terms, number one, we can define a royalty as a periodic payment which is based on the sale or output. So the royalty that is payable by the lessee, the other name for the lessee is the tenant, the person who has leased maybe a land, you can lease a property. So you are the lessee. So it is payable by the lessee to the lessor. Lessor is, the spelling is Lessor. So the lessor is the landlord, the owner of the property, or it may also be the author of a book. So that is royalty. Then the landlord, a landlord is a person who has got the legal right of a property, or he may have a patent right. It may be for, like for example, if we give an example of the KU students who recently tried to invent a ventilator, so they can have a patent, they can get a patent so that anybody who is now trying to manufacture that ventilator using their knowledge is able to pay them for the patent. Or it may also be a copyright of a book. So if you are an author of a book, then for every book that is sold maybe by the publisher, now the publisher will be paying you a specific amount for the copyright. The other term is the tenant. So a tenant is can be defined as maybe an author, a lessee, or maybe a patenter who takes out rights, and those rights, they may be commercial or they may also be personal rights from the owner on the lease against the consideration. So that is the tenant. Then we have a minimum rent, Now, according to the lease agreements, now the minimum rents, which may also be known as fixed rent, or dead rent, is a type of a guarantee that is made by the lease, by the lessee to the lessor. Remember, the lessee is the tenant and the lessor is the landlord, so that in case of a shortage of output, or production, then the tenant will still pay the same amount. So it is the minimum amount that the tenant must pay. So for example, if you have maybe a lease agreement that is based on maybe the sale of items, for example, if maybe you are selling chicken, for example, and then you go to the landlord and tell him that now for our lease agreement, now the minimum amount of money that I will be paying you at the end of the month, whether I surpass my target or not, is maybe 5,000 shillings. So that does not mean that it is the same amount that you must pay. No. If maybe you make a sale of, let's say, 10,000, then the amount that you will be paying to the landlord will be the 10,000 shillings. The minimum rent will only come into consideration if the amount of sales that you have made is less than the minimum rent. Let's say, for example, if you make sales worth maybe 3,000 shillings. So in such a case, what you will pay to the landlord will not be 3,000, but it will be now 5,000 shillings. So it is the minimum amount that the tenant must pay to the landlord at the end of maybe the month or at the end of the week, depending on your lease agreements. So that is minimum rent. The other term that I want us to define is short workings. Short workings. Now, the short working is usually the difference between the minimum rent and the actual royalty that is paid, but on one condition, that the actual royalty payable is less than the minimum rent. So if there is a shortage, like an example that we have given, that your minimum rent that you should be giving to your landlord is 5,000, then at one time you make maybe sales of 3,000. So it means that your actual royalty that you are supposed to pay is less than the minimum rent. So the difference between now the actual royalty, which is less than the minimum rent, and the minimum rent, that is what we call as a short workings. Now you will find that in some cases, now the short workings are always recoupable. You will find that the short workings are always recoupable. Now, what I mean by the short workings being recoupable is that you are able to get it in subsequent years or subsequent periods. So remember, if maybe this month you are paying your royalty on a monthly basis, then in this month, the actual amount that you are supposed to pay is 3,000 and your minimum rent is 5. So what you will be paying is 5,000 and not the 3,000. So the difference between now the 3,000, which is the actual royalty, and the 5,000, which is the minimum rent, the 2,000 shillings is what we call a short working. And remember, this short working, you are paying it, but you will recover it. There are some royalty agreements that have got a clause for recovering the short workings in subsequent years or subsequent months. Let's say that when we, like right now, we are in May. If you experience a short working in May, you may have an agreement that short workings are always recovered in the next maybe 3 months. So you can recover it in June, July, and August, depending on the amount. I hope we are still together. The next term that I want us to define is the ground rent. Next term that I want us to define is the ground rent. Now, the ground rent is a rent that is paid to the landlord for the use of land or surface on the yearly or half-yearly basis. On the yearly or half-yearly basis. Then the other term is the right of recouping. We have already talked about recouping. Recouping simply means that you are getting back the amount of money that you paid to the landlord when the actual royalty was not was less than the minimum rent. Now, this right is always decided for the fixed period or for the floating period. Fixed period means that there is a given duration of time that you are supposed to get back your short workings. For the floating, that one is negotiable. You can negotiate it with your landlord. So the right of recoupment will depend on the royalty agreement that you get with that a tenant gets between him and his or her landlord. The other term is the lease premium. The lease premium. Now, this is just an extra payment in addition to the royalty. Any extra payment in addition to the royalty, and in most cases, the lease premium is treated as capital expenditure, and it is always written off on yearly basis through the profit and loss account. It is always written off through the profit and loss account. The other term is the tax deducted at source, which is commonly referred to as TDS, tax deductible at source. Now, if there is any application of tax deductible at source, as per the Income Tax Act, then you will find that the lessee will make the payment to the lessor or the landlord after deducting the tax deductible at source. And now this is always given by the central government now through the KRA. And now in such a case, if there is any tax that is supposed to be deducted at source, then it means that now the amount of royalty that will be paid will be inclusive of the tax deductible at source. And that should also be charged to the profit and loss account. Now, those are some of the definitions that I wanted us to look at. Next, we can look at the types of royalties. We can look at the types of royalties. Now we have 3 types of royalties. We have 3 types of royalties. The first one is copyright. First one is copyright. Please forgive my handwriting today. Copyright. Now, for the copyright, it provides a legal entity or a legal, it provides a legal right to the author, and in most cases it is the author of a book, or it may be a photographer, or any intellectual work, and it is always payable to the publisher. Now the publisher is the lessee of a book to the author, is paid by the publisher, the lessee of a book to the author. Now the author becomes now the lessor or the landlord. And it is always based on now the amount of sales that are made. So if you are an author of a book, now you will be paid based on now the number of the books that the publisher might have sold for that particular month or for that particular year. The second one is mine royalty. Mine royalty. Now for the mine royalty, now this is always paid by now the company that is mining, and now the lessee becomes now the company, and then the lessor is now the landlord or the owner of that piece of land, or the owner of the mine, or the owner of quarry. Now again, the royalty payment is again based on the output. So you can decide that now for our mine, you will pay us royalty based on the number of kilograms or the number of tons that you are going to sell. So that is mine royalty. Number 3, we have patent royalty. Patent royalty. Now for the patent royalty, it is paid by the lessee to the lessor or the tenant. The lessee is the tenant and the lessor is the landlord, on the basis of output or on the basis of production of respective goods. So for example, if we give an example of the KU students who came up with a ventilator, if maybe a company is willing to use that their knowledge to mass produce the ventilators, then now they will be paid on now the number of ventilators that that manufacturer or that company will be selling, maybe on a yearly basis or on a monthly basis. So those are the 3 types of royalties that we have. So we have copyright, we have the mine, and we also have got the patent royalties. Now, if we can look at an illustration, assume that MS Hyderabad, it is a publisher. It printed a book on Java on the minimum rent of 1 million shillings. So you can assume that now the minimum rent is 1 million. 1 million. Remember, in accounting 2, management accounting 2, we said shillings comes first. So it is 1 million shillings. That is the minimum rent. Then we are told, and the royalty is paid per, we are told that the royalty is paid per annum, so that means per year. Then we are told that the royalty is payable at 20 shillings, at 20 shillings. The royalty is payable at 20 shillings per book. Shillings 20 book. So for every book sold, the royalty is 20 shillings. Then we are also told that now in a particular year, the company sold 75 copies. So in year one, so we have year one, year one, sorry for my handwriting. Year one, the number of copies that were sold were 75,000. 75,000 copies. And then in year two, the sales fell to 45,000 in year two. 5,000, so I'll use a C. 45,000 copies. So we are asked to calculate the amount of royalties payable. Now remember that we have said the amount of royalties that will be paid will depend on the number of copies of the books that would have been sold in a particular year. But also remember that that amount should not go below the minimum rent, which in our case, in the example that we are looking at, the minimum rent is 1 million shillings. So remember, whatever will be paid should not go below the 1 million. So to determine the amount of royalty that is paid per year, will take the number of copies of books that are sold in that given year times the royalty payment per book. So we can solve that. Now for year one, for the first year, what we'll have is that we are having, sorry, not 45, but we are having 75,000 copies. 75,000 copies. Then we are multiplying this by the royalty amount per copy, which is 20 shillings. So if you multiply this, then you will find that now 75,000 times 20, that will give us 1 million. Yes, that will give us 1,500,000 shillings. 1,500,000 shillings. So that is the actual amount of sales that this company had made. Remember that the minimum rent is 1 million, but now the actual amount of sales that has been made is 1,500,000, meaning that the actual sales is more than the minimum rent. So the amount of payment that will be made now 1,500,000 for year one. Now for year two, again, we go through the same process. Now we have 45,000 copies. 5,000 copies. Then we are multiplying the 45,000 by 20. If you multiply that, now the product there, the product will be 900,000. You can confirm from your letters, 900,000. So that is the amount that this company has got from the sale of books. So it means that now what they are supposed to pay is the sales. Remember, we have said that the payment will be based on the number of sales that would have been made. So we are going to now, the company is supposed to pay the 900,000, but remember that we have a minimum rent. We have a minimum rent, or which is 1 million shillings. So the payment should not go below the 1 million shillings. So now that there is the 900,000 there, now the payment that we will make now in year two, the payment will be 1 million and not the, it will be 1 million and not the 900,000 shillings. So in such a case, in year two, we will now have a short working. We now have a short working. We have a short working of now the difference between the 1 million and short working. So that will be given by 1M minus 900,000. That gives us the difference there is now 100,000. So the short working will be 100,000. So that is how we go about that. So maybe we can continue unless there is a question. Unless we have a question. So if there is no question, then we can continue. Now, when we are making these royalty payments, remember, we must be able to prepare the books of the tenant and also the books of the landlord. You must be prepared to prepare those books, the tenant and the landlord's book. Start with the tenant. We start with the tenant. So the tenant is the lessee now, the person who has now leased maybe the mine or the publisher of a book or maybe the patent. So for the tenant, we have several cases. For example, one, when an amount becomes payable to the landlord. Remember, you have not paid. The amount has just become payable. Now, in such a case, when amount becomes payable, so I'll write in short form, amount becomes payable. Now, the entries to be made is that one, you will debit the royalties account, we debit the royalties account, so we can debit royalties, debit the royalties account, and then at the same time, so we can have XX. At the same time now, when you go to the landlord's account, you will credit the landlord's account, remember, with the same amount. You credit landlord with the same amount. So that is the first case when the royalties becomes payable. Number two, now when the tenant actually pays the amount to the landlord. Now when the actual payment is made, now we will debit the landlord's account because he's receiving the amount, and then we credit the cash book. So when the amount is actually paid, we debit the landlord's account with the actual amount that is paid, and we credit the cash book with the same amount. Credit the cash book with the same amount. At the end of the financial year, then we are supposed to debit the manufacturing or the trading profit and loss account, and at the same time credit the royalties account. Remember, a transaction from your financial accounting one, a transaction usually affects two or more ledger accounts. So at the end of the financial year, for in the books of the tenant, you debit the manufacturing or the trading profit and loss account, and then you credit the royalties account. Then we move to now in a case where there are working. So in the first case, we were looking at the accounts of the tenants, and we were assuming that there will be no short workings. We were assuming that there will be no short workings. Now, if there are short workings, we will still make the entries, but now we will take into consideration of the short workings. So now, for example, if the royalties based on now the output or the sales falls below the minimum rent. So instead of just debiting royalties and crediting the landlord's account, now what we will do is that we will debit royalties, we debit now the amount that we are going to debit the royalties with are the amounts based on output. Now, for example, in our case, in year two, we have seen that now the amount of output was 900,000, and it was less than the minimum rent. So the amount that we should have debited the royalties account with will be now the 900,000. So we debit royalties, and the amount there is 900,000, and then we will also debit at the same time. We will also debit short workings account. We also debit the short workings. Now for the short workings, now the amount that we will be using here is the amount, the difference now between the output, the difference between the output and the minimum rent. So if we use the other case, an example that we gave out of the publisher, then now the amount that we would have debited here would have been 100,000 shillings. Then at the same time, we are supposed now to credit the landlord's account, supposed to credit, landlord's account. And for the landlord now, the amount that we are going to use is now the minimum rent. Minimum rent. Amount in the minimum rent. Like in our case that we gave, the minimum rent was 100,000. So this is to recognize now the royalty payment. Now, when the actual payment is made, we will debit landlord and we credit cash book again with the minimum rent, because that is what will be paid. Now, if there is a short workings at the end of the financial year, their accounting entries to be made are: number one, we will debit the manufacturing or trading account. You can also show that. We debit the manufacturing or the trading account. And at the same time, we credit the royalties. We credit royalties. Now that is when the actual payment is made. Credit the royalties. And remember, any balances in the short workings account, is supposed to be carried as an asset. You are supposed to carry it as an asset. So for that particular period. But now in the future years, when royalties based on output exceed the minimum rent, in the future years, when the royalties based on output exceed the minimum rent, then the entries to be made is: one, you debit the royalties account now with the amount based on output. Number two, you credit the landlord's account again with the same amount. But when the amounts are paid to the landlord, when you pay the amounts to the landlord, now you will debit the landlord's account and credit the short workings account with any amounts that you have saved. Credit the short workings account with any amount that you have saved. Now, at the end of the financial year, again, you are supposed to debit the manufacturing or the trading account. And you are also supposed to credit the royalties. Again, you carry any balances in the short workings for the amounts that you may have to recoup in the future period. So those are the entries that are expected of us. Remember, when you are preparing the tenant's account at the same time, remember we have said when you debit, you credit the landlord. So at the same time, you'll also be preparing the landlord's account. So we don't have again to go back and repeat the same transaction. I hope we are together. And what I also want you to know is that before you prepare the tenant or the landlord's account, there is something that is called an analytical table. Analytical table. Now, this table is only helping us. This table is only helping us to know the amount that we are expected to pay. Is only helping us to know the amount that we are expected to pay at any given time. So maybe we can put it down, analytical table. Analytical table. So this is what will be helpful. Now, in the preparation of the analytical table, you simply have to know now the output for each year, and you should also be able to know the minimum rent for a given year. And the other thing that you also need to know is determine whether there is a short working or not. So that will depend on now the amount of the royalty that is payable vis-a-vis the minimum rent that is available at a given particular time. So I want to share a video on how we can prepare an analytical table. So please pay attention on how we prepare the analytical table. Then after the video, I will ask that now we go to our discussion forum and be able to solve a problem that I'll post there. So please feel free and